For 150 years, central banks ignored silver. They bought gold by the thousands of tons. 36,000 tons sitting in vaults worldwide as of 2025. Gold was the reserve asset, the monetary metal, the safe haven. Silver? Silver was for industry, for investors, for anyone except central banks. Until 2024, when everything changed. Russia became the first nation in modern history to formally announce silver purchases for state reserves. Not quietly, not through back channels, publicly. They allocated 51.5 billion rubles, $535 million over 3 years for silver, alongside gold, platinum, and palladium. Silver was now officially part of Russia's strategic reserve program. Then Saudi Arabia followed, acquiring 932,000 shares in the iShares Silver Trust, SLV, and India made a revolutionary regulatory change, approving silver as loan collateral starting April 2026, elevating its status in the financial system for the first time. 3 major moves, 3 different approaches, but the same signal. Silver is being recognized as a strategic and monetary asset again, after 5 decades of being ignored. And if you understand what happens when institutions start positioning in something they previously ignored, you'll realize the window to acquire silver at current prices is closing fast. Let me show you exactly what's happening, why sovereign entities and central banks are moving into silver now, what the data tells us about supply constraints they're exploiting, and why this shift, once it accelerates, could push silver prices far beyond anything we've seen in recent history. Because this isn't about speculation. This is about understanding institutional behavior. And institutions are positioning. Start with Russia, because their move was deliberate, strategic, and it came with a clear rationale. Russia's draft federal budget for 2025 through 2027 explicitly includes silver for the first time in modern central banking history. And here's what makes it brilliant. Russia is the world's 8th largest silver producer at 38.5 million ounces annually. They're not buying silver from global markets and driving prices up immediately. They're leveraging domestic production, building reserves from their own supply, creating a closed loop system. This matters because it reduces external dependencies. When Western sanctions froze $300 billion in Russian foreign reserves in 2022, it was a watershed moment, not just for Russia, for every central bank watching. The message was clear. Dollar-denominated assets, treasury bonds, even gold held in Western vaults can be frozen, seized, neutralized with a keystroke. But physical silver produced domestically and held domestically, nobody can touch it. No remote confiscation, no digital freeze, just metal, in vaults, under sovereign control. Russia's program runs through 2027. That's 3 years of steady accumulation at a budget of $535 million, not massive in dollar terms, but massive in signal. Because if Russia, facing Western sanctions and dollar weaponization, chooses to add silver to state reserves, what does that tell other nations facing similar pressures? China, Iran, North Korea, any country that fears financial isolation. Silver becomes an alternative store of value, a hedge against dollar system exclusion. Saudi Arabia took a different approach. They acquired 932,000 shares in SLV, the iShares Silver Trust. This is different from Russia. They didn't announce a central bank reserve program. They bought ETF shares through investment channels, paper silver. But here's the critical detail. SLV shares can be converted to physical delivery for large institutional holders. Saudi Arabia, with its massive financial resources and sovereign wealth funds, positioned itself to potentially demand physical silver from SLV if they choose. This gives them optionality. Trade the paper, or demand the metal. And if they demand metal at scale, SLV must deliver, or suspend redemptions like they did in April 2020 when supply tightened. Then there's India's regulatory revolution. In April 2026, India will implement new regulations recognizing silver as acceptable collateral for lending. This might not sound dramatic, but it's seismic. For the first time in modern Indian banking, silver will have official monetary recognition in the financial system. Banks can accept silver as loan collateral. This elevates silver from commodity to financial asset in regulatory terms, and it opens the door for broader institutional acceptance. India already has deep cultural ties to silver. Indian households hold an estimated 25,000 tons of silver, one of the largest private stockpiles in the world. The Reserve Bank of India, which holds 880.2 tons of gold reserves as of November 2025, making India the 8th largest sovereign gold holder, understands precious metals. By approving silver as collateral, they're acknowledging what households already know. Silver preserves wealth. And in a world where currency stability is questioned, metals matter. 3 sovereign entities, 3 strategies, but 1 pattern. Official and institutional buyers. Entering a market they abandoned in the 1970s, Russia buying for reserves, Saudi Arabia positioning through ETF shares, India legitimizing silver in the banking system. And this is just the beginning, because when institutions move, they don't move alone. They move in waves. Poland bought 49 tons of gold in Q1 2025 alone. Turkey increased reserves from 117 tons in 2009 to 543 tons by 2024, a 364% increase. China added gold for 18 consecutive months through May 2024. When central banks see one bank accumulating, others follow. The herd mentality isn't just for retail investors, it's institutional. Now let's talk about why sovereign entities are moving into silver now. Timing matters, and the timing is critical. Silver faces its fifth consecutive year of supply deficits. 2021, 150 million ounces. 2022, 142 million ounces. 2023, 184 million ounces. 2024, 149 million ounces. 2025 projected 117.6 million ounces. Cumulative 5-year deficit approaching 750 million ounces. That's 300 tons consumed beyond what mines produced. Industrial demand hit a record 680.5 million ounces in 2024. Solar panels alone consumed 232 million ounces. Electric vehicles, electronics, 5G infrastructure, medical applications, all require silver. And these aren't cyclical demands. These are structural, locked in by government mandates for renewable energy. Automaker commitments to electrification. Technology advancement requiring silver's unique properties. Mine production? Flat, 822 million ounces in 2023. Projected 835 million ounces in 2025. That's 2% growth while demand grows 4 to 6%. And here's the killer. 72% of silver comes as a byproduct of lead, zinc, copper, and gold mining. It doesn't respond to silver prices. When base metal prices are weak, mines close. Silver production falls, regardless of silver demand. This makes supply inelastic, unresponsive, fixed. Sovereign entities see this. They see COMEX registered silver at 138 million ounces as of December 1st, then 47.6 million ounces claimed in 4 days. They see London Free Float estimated at 135 million ounces by TD Securities, with lease rates spiking to 40% in October. They see Shanghai inventories below 446 tons, the lowest since 2016. They see China implementing export controls on silver starting January 1st, 2026, locking down 15% of global supply, and they're positioning before prices reflect these realities. Because silver at $6,700 per ounce, while an all-time high, is still cheap relative to gold. The gold to silver ratio sits at 68 to 1. Historically, it averages 40, 60 to 1 long term. Even reverting to 50 to 1 puts silver at $86 with gold at current levels. Sovereign buyers aren't allocating to silver because they think it might go up 10%. They're positioning because they see potential for multiples. And when an asset has that kind of upside, with limited downside due to industrial demand floors, institutions allocate. Here's what happens next. Russia's $535 million program runs through 2027. Other BRICS nations, watching Russia's move, could consider similar programs. Brazil, South Africa, Iran, Egypt, Ethiopia. These aren't hypothetical. These are countries that already coordinate economically, already discuss alternative reserve assets, already seek to reduce dollar dependency. If even 3 more nations allocate $200 to $500 million each for silver over 3 years, that's $600 million to $1.5 billion in new institutional demand. Sounds small? It's not. Annual global silver mine production is 822 million ounces. At $67 per ounce, that's $55 billion. Sovereign entities allocating $1 billion annually represents 2% of total supply. Except they're not buying at market. They're accumulating strategically, quietly, from domestic production, from private transactions, from OTC markets. This removes supply without spiking spot prices immediately, until it does, when the cumulative effect becomes visible, when inventories drain, when delivery demands can't be met, and investment demand returns. Physical investment fell 22% in 2024 to 190.9 million ounces. Retail was taking profits, selling into strength. But in 2025, as prices kept rising, as supply concerns became mainstream, investment demand is projected to rise 7%. When retail realizes that sovereign entities are positioning in silver for the first time in 50 years, psychology shifts. If it's strategic enough for Russia's reserves, if Saudi Arabia is accumulating SLV shares, if India is elevating silver to collateral status, maybe individual investors should pay attention. That psychology drives demand spikes. And when demand spikes in a market already in deficit, prices don't rise gradually, they explode. The mathematics are simple. Supply at 835 million ounces from mining. Add 200 million from recycling. Total supply 1.35 billion ounces. Demand at 1.16 billion ounces. Deficit of 125 million ounces annually. Now add sovereign accumulation. Even modest buying of 50 million ounces annually. Less than Russia's domestic production alone widens the deficit to 175 million ounces. That deficit gets filled from above-ground inventories, but COMEX registered is at 138 million. The London float at 135 million. Total easily accessible silver is 273 million ounces. At a 175 million ounce annual deficit, that's 18 months of supply. Then what? Prices rise until industrial demand gets destroyed, or mines increase production, which takes 7 to 10 years, or recycling surges, which requires much higher prices to justify recovery costs. Sovereign entities understand this math. They're positioning while supply still exists, while lease rates, though elevated, haven't gone vertical. While physical premiums, though rising, are still manageable. They're cornering silver while it's still cheap. Not cheap in absolute terms. Cheap relative to where it's going when supply exhaustion becomes undeniable. The window is closing, not in years, in months. China's export controls start January 1st, 2026. That's 10 days from now. Russia's accumulation continues through 2027. Saudi Arabia's SLV position can convert to physical. India's collateral regulations activate April 2026. And if Turkey follows Russia's lead, if Poland diversifies from gold into silver, if any of the dozens of central banks buying record gold decide silver offers better leverage, the market shifts permanently. Because here's what most people miss about this entire development. Sovereign entities positioning in silver isn't just about them accumulating metal. It's about what their actions do to market psychology. When Russia announces a $535 million silver program, every analyst, every institution, every sophisticated investor sees it, and they ask the same question. What do they know that we don't? What are they seeing in supply-demand fundamentals that justifies breaking 50 years of precedent? And when those analysts run the numbers, when they see the deficits, the inventory drainage, the industrial demand growth, the supply inelasticity, they reach the same conclusion. Position now, before the window closes. Now, here's the part that should concern you. We've talked about sovereign entities buying silver. We've shown the supply crisis. We've explained why timing matters. But we haven't talked about who already controls the silver that these institutions are competing to acquire. Because in a market this tight, where free float is measured in weeks of supply, control matters more than anything. The entities holding massive physical stockpiles, the refiners managing metal flows, the exchanges running warehouses, they're the ones who decide when and if silver comes to market. And their positions dwarf what sovereign buyers are accumulating. I've got a video on this channel that breaks down exactly who controls the world's silver supply. Not the miners producing it, not the sovereign entities buying it, the institutions that have quietly accumulated positions so large they can influence prices, delivery timelines, and market function itself. When you understand that control structure, when you see how concentrated the remaining supply is, the sovereign buying story takes on a completely different dimension. Watch that next. Because understanding why sovereign entities are buying is step one. Understanding who controls what they're trying to buy is step two. And when you combine those insights, you'll see why the window to acquire silver at current prices isn't closing slowly. It's slamming shut. Sovereign entities ignored silver for 150 years. Russia broke that pattern in 2024. Saudi Arabia positioned through SLV. India elevated silver to collateral status. The precedent is set. The window is closing. Find out who's already positioned ahead of them. Watch the next video.